Hi everyone. Well, by now you can tell I am not Margot Robbie and this is not a bubble bath. But what I am here to do is to answer some questions about bonds. My colleagues Shweta Singh and Michelle Nofel have been out visiting clients the last couple of weeks and have come back with 4 interesting questions about bonds. Given how well the first question is, given how well the stock market's been doing, why buy bonds at all? My clients have only seen red over the last 2 years in their bond portfolios. Second question is, why buy a bond over a money market fund? Third question is, when is the right time to buy bonds? And finally, why is Citi different, focused on short-term bonds versus long-term bonds? Well, let's take each of those questions one at a time. The first question is, why buy bonds when the equity market's doing so well? I gather that was before the last few weeks of volatility has hit. And we've seen that bonds are negatively correlated to the equity market, which means as the equity market goes down, bond prices go up. An investor needs non-correlated assets in a well-diversified portfolio. Bonds provide the ballast to a well-diversified portfolio. Why buy bonds versus a money market fund? Well, a money market fund has a high degree of reinvestment risk. And what does that mean? That means that an investor may not be able to buy a money market fund today at the same yield level they did a year ago. That is the definition of reinvestment risk. So when is the right time to buy bonds? Okay, quite frankly, I'm a bond guy and I'm going to be talking my book. But in a well-diversified portfolio, you should always have a representation of bonds of some sort. Now, not all bonds are created equal. And there are value metrics that apply to each, and we'll touch on that when we answer the final question. And that is, why are you guys focused on shorter duration bonds versus longer duration bonds? And there are any number of metrics that we can use to answer that question, whether it be real yields, slope of the yield curve, or my favorite, the value metric. And that value metric says, if I buy a 5-year Treasury security, I get 95% of the income of a 10-year Treasury security with only 50% of the duration risk. That's a value by the way we look at the market. Finally, you can't talk about bonds without talking about credit risk. Credit spreads are extremely narrow and have been that way for a long time. But the economy has been doing quite well over that same period. That kind of explains why they've been so low and so stable. We're going into a period where the economy is not as stable. You have the talking heads starting to use the R word, recession. Given that, we would expect quality spreads to begin to widen to compensate investors for the risk of credit and volatility. So this is the Reader's Digest version of the answers to that question. I don't know whether everybody still remembers Reader's Digest, but it's the short answer. If you want the longer answer with the math behind it, please visit our latest blog.